Muchísimas gracias. Richard, thank you so much for coming to the Amafor event. You are part of this big family, and thank you for coming. Especially, Richard just flight last night and coming from Japan. I think that it's a little tired, but thank you for coming, Richard.
Thank you.
I think the first question is, how is the platform of alternatives in Franklin Templeton? I think it's going to be useful for us to know how is the capacities that Franklin Templeton has.
Good. Let's start with that. Thank you very much, Salvador, and it's great to be here. Franklin Templeton, hopefully many of you are familiar with the name, is a large 1.5 trillion US dollars asset manager, typically known as a traditional asset manager. What you may not have noticed, if you haven't been following it closely though, is that Franklin Templeton has making a very aggressive push into alternatives. Franklin Templeton's alternatives division now is 260 billion. That would rank it in the top 10 largest alternative credit managers in the world. Still very small compared to the 1.5 trillion, but is a growing push. Our firm, Benefit Street Partners, is part of that 260 billion. Also included there is Lexington Partners. Lexington Partners does secondary private equities. Clarion Partners, which is a real estate investment firm. There's another business called K2, which is a hedge fund advisory business. And then lastly, Benefit Street Partners. So our firm, just to give you the capabilities so you can understand as we talk through some of the market dynamics, is 80 billion of assets under management. All we do is credit. We are lenders, we are credit investors. We have strategies including private credit, which is a very popular strategy in the US and is probably what we're best known for. We have special situations, which is becoming more popular as default rates potentially start to rise. We have liquid credit like CLOs, broadly syndicated loans, high yield bonds. And lastly, we have one that doesn't fit quite exactly into that group because it's real estate. We have real estate credit or real estate lending, which has also become a very popular business lately.
Very interesting topics. I think we can go more deeply. What is your vision in these times of the market?
Good. Well, maybe this is another good time to level set a little bit. The market is probably as interesting a market as we've seen in a long time. I mean, I've been doing this almost 4 decades. And I would say that this is one of the best opportunities we've seen, certainly at least since the global financial crisis, because there's so much going on. Most investors, they want to talk about the thing in front of their nose, whether it's inflation, recession. Everybody wants to know, what's the likelihood of a recession. People want to know if the wars are going to impact the supply chain, unemployment. I think the biggest factor impacting the markets in profound ways has been the rapid and dramatic rise in interest rates. The implications for that for a credit lender, for a credit firm like ours, are really big. On one hand, it's one of the best things you could ever happen to you as a credit lender. More interest rate, the base rates have gone from near zero to SOFR right now is over 5%. So we're making more money, more interest income, bigger yields, everything better. But did you ever hear the expression when you were a kid of too much of a good thing is never a good? It's like eating too much candy. With that higher interest rate also comes the negative of an added burden on the companies that we lend to. So if they were paying 6% interest rate before, they may be paying something like 10, 11, or 12% interest rate. And the weaker companies aren't going to be able to pay that rate. That means defaults are very likely to go up. So good news in the near term is rates are higher. Bad news is going to play out over time is that you're going to see more defaults.
But Rich, you can see the system banking is one step back. It's not kind of advertising that we need to have a lot of care in the debt, and now we are seeing a lot of activity in the funds of debt. It's a little contrary, no?
Well, So one of the reasons that the investment opportunity is so good is let's examine the supply and demand. M&A is very low right now. I think buyers want to buy things at the prices that they think the market should have reset to, today's price, and sellers are still stuck with yesterday's price in their head, and there's still a gap between the two, and there hasn't been a lot of M&A. That will certainly increase over time. So you would think to yourself, with lower supply, that answers your question, but demand is also lower for a bunch of reasons. One is fundraising has been okay, but it hasn't been robust. Two is one of the best ways that firms like ours have to invest capital is when loans repay and you recycle that capital into the next loan. Well, nobody's repaying because who would be stupid enough to refinance a low interest loan with a high interest loan? We used to, every year in our private credit business, get back about 35 to 40% of our loans would prepay. We'd reinvest every year. Now it's like 10%. So there's much less reinvested capital. And lastly is the banks. The banks have really been suffering for a lot of reasons. One of the biggest reasons is banks' biggest alternative investment is real estate or real estate lending. If you're a bank, it would be as a lender. And the banks have been getting killed on their commercial real estate, especially their office loans. We can talk about that more when we talk about real estate lending. But the commercial real estate market, specifically for office in the U.S., you certainly all know about it. You know, the work from home. I think the story is being undersold. I think it is a real problem, and it's a ticking time bomb for many banks. That and what it's done in the near term is it's taken them out of the market. They're not making loans to corporates and to real estate. So for those reasons, there's less demand, even though there's less supply. That's what has kept the market so attractive.
Okay. Maybe we can jump to real estate, but I have a lot of questions in the lending side. But in real estate, what is your vision? What is the opportunities? Because there are many sectors. Office is a complete disaster, but what is the sectors that you will focus?
So we focus our lending, we haven't made an office loan in a couple of years. Where we focus our lending is mostly on multifamily apartment buildings. The story is pretty obvious. If work from home is the reason that office is suffering, then people are moving their offices to their homes. You know, they're gonna increase their investment in where they live. And what this has resulted in for our multifamily lending business is we've been seeing some pretty nice rent growth. Despite the economy being relatively slow, you're seeing some good rental increases, and occupancy has been strong. It's slowing down a little bit, but that's been very good. The other great thing about the multifamily sector is in the US, the lender that all of our loans, not all, but many of our loans get refinanced to is the federal government agencies, Freddie Mac and Fannie Mae. Mm-hmm. This is cheap money that good borrowers, if they did their job and built a good property or renovated or got their rent roll stabilized well, they have access to a takeout, which solves the problem of the illiquidity in the lending market. So multifamily has been very attractive. We also lend to hospitality or hotels, particularly destination hotels, not urban, office-oriented hotels, but vacation-type hotels. We lend to warehouses, self-storage, those kind of things. But predominantly it's multifamily. And right now we're underwriting a multifamily loan with 65% loan to value. That value is going to increase, we think, as the owners, improve the properties. We're doing it with interest rates of like SOFR plus 400 to 500. So you're earning, with some fees and some back-end fees, 10, 11, 12% on these real estate loans. Mm-hmm. And I would say it this way, and maybe this applies to not just real estate, but it'll apply to everything we're talking about. In the old days, when we used to have what they used to call a junk bond market, remember that? It was originally called high yield bonds. And the reason they were high yield bonds is they were paying a big coupon. And people would argue that if you're getting a 10, 11% coupon, then you can afford, if everything went bad in your portfolio, to lose 10, 11% of your principal value, and you still wouldn't have a loss in that year. You have all that income to protect your gains. Well, we haven't had that environment since the global financial crisis. We've been living in an incredibly low interest rate market. A high yield bond was 5%. You know, now it's 11% in the example that I'm giving you. It helps to fix a lot of problems. I said the default rate's going to go up, but I don't think it's going to go up that much that it's going to offset, you know, all that income that you're earning.
Yeah. Saying that, I remember that it's so different these times, like a GFC. What is the main difference that you are seeing at that crisis versus the time that we are living now?
Well, the GFC, I think, was very unique. I hope we never have to go through that again. But the central problem in the GFC is the economy was relatively okay. It was the illiquidity in the financial markets. I think that's a similar problem today. It's just much smaller than that. The difference is the increase in rates. So I'll give you an example. A company we lend to, now we're not talking about real estate, let's talk about a corporate loan. We lent to in 2021, on average, had interest coverage ratio of 2.7 times. In other words, their earnings were 2.7 times larger than their interest expense. That's really good. I mean, that's a good margin for error. You'd feel good about a portfolio that you can lose a lot of cash flow and you would still be able to pay your interest. Well, if that portfolio didn't change, all the companies earned the exact same amount, but just resetting that to higher base rates, higher SOFR, that interest coverage ratio goes down to 1.6 times, from 2.7 to 1.6. 1.6 is still okay. You're still paying your interest and have a comfortable margin for error, but it's not nearly as comfortable. So the lower performing companies are likely to default, right? Okay. And the market's going to be less forgiving because you have less margin for error. And I think that would summarize the problem we're in today, is that the markets are good, the markets are sound, it's just companies are struggling with the higher interest rates, simply put, and defaults are particularly going to start going up when these loans mature. Okay.
You mentioned, let me back to one of your first comments. You talk about and mention direct lending and special seats. In the case of Benefit Street, could you talk a little more, what is the opportunities that you are looking in the different types of lending?
So direct lending, let's just go through them one at a time. In alternatives.
Yes.
Direct lending, some people call it private debt or private credit, is just simple. We're lending directly to companies. We're not participating in a syndication of, we call that a broadly syndicated loan. So these companies are a little bit smaller. They're not small. The average loan size is, or the average enterprise value of the company is anywhere from $300 million to $1 billion. So these are pretty substantial companies. But we're lending directly. The advantage of direct lending over the broadly syndicated market, well, first, the disadvantage is in the broadly syndicated market, you could theoretically buy and sell a loan any day. So if you're making a direct lending loan, it's less liquid. We sometimes are the only lender, or we'll be in partnership with one or two other lenders. So it's less liquid. But because we're doing all the work ourselves, we can set our own covenants, which are always better than what you're going to get in the broadly syndicated market, and the interest rate's going to be higher. For the same, I think, underlying risk. The trick is you just have to have a deep team that can do all that work to originate, structure, monitor, and ultimately monetize the portfolio. This is why ever since the global financial crisis, when banks got regulated out of this market, they went up market and they only want to do the big deals. This is why these middle market deals or direct lending has been so popular. Same story, you're getting 11, 12% yields when we used to get like 6. So it's a lot of income to offset losses. And the last thing I'll say about that is everybody says, is there going to be a recession? Well, if we were doing this panel, the question let's say 6 months ago, the question I would have probably been asked is how big will the recession be? Small, medium, large? The question today that people are asking is, will there be a recession at all? And I think the consensus view is probably not. So the US economy has been very resilient. Inflation remains difficult to get into the Fed's target. So, you know, it's likely rates are going to stay high for a while, and this is the environment that we're going to be in, which is why direct lending, to me, seems like a logical place that you'd want to look at in an environment like this, even though default rates are likely to increase. The other business that we have is special situations. Now, special situations is a nice way to say that you invest in companies that have troubles or are in default. As default rates increase, if we're right, default rates are going to start increasing, that sector starts to become more interesting. It becomes more interesting because the more defaults, the more opportunities there are to invest. So it's a natural hedge, I would think, in many ways against a portfolio. So special situations is you're betting on problems in the markets or in the economy, and then you have the opportunity to buy low and sell high. Most firms like ours that do special situations actively manage. They take control positions in the companies as a lender, sometimes to end up as the equity holder, sometimes to lead a restructuring process. So these are very credit intensive.
Okay.
We talked about commercial real estate, but again, we're basically lending first lien, low loan to value into the commercial sector, just like we talked about, again, with very high yields to offset potential increase in default rate. And one thing I just want to say before the next question is we talk about default rates increasing, and that scares a lot of people. But I want to put it in context. The default rate we've been living with for the last 10, 12, ever since the global financial crisis, has been under 2%. It's been closer to 1% many of those years. But it's been under 2%. It's created an environment which is great if you're a lender, but it's also very difficult for a good lender to differentiate themselves because no matter what you buy, generally the market bails out your problems. So the market almost rewards irresponsible risk. Boy, that's going to change. The market's going to start differentiating, et cetera. But the default rate that was 1.5%, 2%, we think it's going to increase like double to 3 to 4%. That's a big percentage increase. I mean, that's dramatic. But based on historical averages, it's not very big at all. I mean, historically, looking out over a 30-year period, it's more like 6 or 7%. There's been times, global financial crisis included, where it was double digits. It was 15% at one point. So still, default rates are going to go up, creating this challenging market and an opportunity, but by historical standards, it's still not that bad.
Okay. We mentioned a lot of things, but what happened with the sectors? What are the sectors that you think that they have less issues?
Good. So this is where my presentation gets boring. Because if I was an equity investor or private equity or real estate property investor, you'd be telling exciting stories about tech companies that are going to grow their earnings or new products or multiple enhancements. We don't do any of those things. We're a lender. We generally make a loan at 98, 99, and if everything goes perfectly according to plan, we get back 100 at the end, and we get the income in between. So we're not looking to be heroes. By the way, the downside, you could lose 100 points. One loss can offset all those gains. So we're very focused on, in the worst day in hell, as we say, what could go wrong? So the types of companies we gravitate to are boring, stable, very predictable, low capex, so you're reinvesting your capital to deleverage in businesses with good market shares and good brand names. So what we generally avoid is anything that is a big commodity association. For example, we haven't made an energy loan in 4 years, 5 years, because the price of oil just moves too much. as you know. We generally don't do anything in tech because we don't want to see what's going to happen in the future. We like to see what happens now. There's risks in every sector, but we try to be as thoughtful as we can about eliminating the biggest risks.
Oh, thank you so much. Unfortunately, the time flies, but I don't want to miss this opportunity to have this gentleman here. If you accept 2 questions
Sure.
for the public. I don't know if you have some questions. It's a great opportunity to talk with Rich, one of the experts in debt worldwide. If somebody wants to do some questions. Sí, no sé, por ahí.
Hi, good afternoon. Santiago de Velasco from Principal. Hi, Richard. Thank you for your presentation. Talking about the direct lending market that I think is very interesting, I only wanted to ask if you could elaborate a little bit more about the risks and the challenges that might be ahead in the following months or perhaps couple of years, given the default rates you mentioned, and also the pros that you see, the benefits you could see in this sector, please. Thank you very much.
I'd be happy to answer that. So the risk, no matter when you ask this question, is always the same. It's default risk. That separates the best managers and the weakest managers. But there's an interesting point that I would make. 2 things can be true at the same time. For new investing, as I said, I think it's one of the most interesting, best investment opportunities we've seen in a very long time. But for existing portfolios, it's going to be much more challenging because a loan that was underwritten 2 years ago, as I just discussed, has a lot lower interest coverage than a loan you're going to underwrite today. How do I explain that? When we're underwriting a loan today, we're trying to adjust for the changes in the market by changing the structure of the loan. I'll give you a good example. A private equity firm is typically the borrower in many cases for these middle market loans. 2 years ago, a year and a half ago, the average amount of equity that a financial sponsor put in a deal was 40%. So if they were making an acquisition of $1 billion, or I'm just making up a number, they'd put in 400 and they'd borrow 600. Mm-hmm. Guess what that is today? It's the exact inverse. A deal today, on average, is 60% equity, or 600 million, and 40% debt. That's a big change. So one of the reasons I said the investment opportunity is so good today is because these deals are less levered. The sponsors obviously have more equity in them. We're getting better covenants, and we're getting still that good pricing with that big base rate and upfront fees and all, and call protection and all those things. The loan that was made 2 years ago doesn't have all that. And you're subject to the same risk, so you have more leverage, weaker covenants, etc. So I think the risk is always defaults, but where the challenge is going to be is in existing portfolios. And I think the way you best mitigate that risk, if you're either own an existing portfolio of loans or you're thinking about buying in a secondary or something, is you look for managers that are very large and experienced, that have been through multiple cycles, have big teams, and you look for portfolios that are defensively structured. Our portfolio, for example, is 90+% first lien senior secured with the low loan to value ratios. So if you were successful in being risk avoidance strategy over the last few years, I think that's going to really help you going forward. Of course, there'll always be one-off names that will have problems and potentially default, but again, the interest that you're getting from these loans is hopefully ample to offset that even in existing portfolios.
Thank you so much, Richard, and some applause to Richard.